Welcome back to Stock Talk, everyone. Let's jump right into another deep dive. Before we get started, though, just a quick reminder. If you find this exploration valuable, please take a second to subscribe, maybe share it, give us a like. It really helps us keep bringing you these insights. Okay, and now for the important heads up. This deep dive looks at an investment thesis, purely for informational purposes. It is absolutely not investment advice. You should always do your own research, your own due diligence, or, talk to a licensed financial advisor. The analysis we're digging into today is based on public info as of May 22, 2025. So obviously it won't reflect anything that's happened since then. And remember, past performance doesn't guarantee future results. And yeah, every investment carries risk. You could lose money. Okay, got that covered. Let's unpack this. Today we're looking at a really interesting investment thesis we received, dated May 22, 2025. It focuses on Target Corporation, ticker TGT, and makes a pretty bold case for it as a contrarian value play. So our mission here is to sift through this document, pull out the key nuggets of knowledge for you, and really understand why the author thinks Target, despite its recent struggles, might be a compelling opportunity right now. We'll look at their reasoning, the strengths, the weaknesses they highlight, and the strategy they're proposing. So right off the bat, the thesis calls Target a compelling contrarian investment opportunity at current valuations. Contrarian value.
For Target. I mean, that definitely grabs your attention. Given the headlines, what's the starting point here?
Yeah, it's fascinating because the thesis immediately throws this stark contrast at you. It points out that as of May 22nd, the stock's at $93.01. But the kicker is that's down like a staggering 63% from its peak back in 2021. 63%.
Wow, okay, that's a huge drop.
Exactly. And that massive drop is central to the value argument. The thesis points to valuation metrics that the author sees as really attractive now, like the forward PE ratio, what investors expect to pay for future earnings. It's just 11.3x. And that's significantly below Target's own history. They obviously trade somewhere between 15 and 17 times earnings. So for this author, that low TE is a big flashing light for potential undervaluation.
And the dividend, I'm seeing a number here that definitely stands out.
Absolutely. The dividend yield, 4.6%. Which is high. And the thesis stresses this isn't just like a number plucked out of thin air. It's supported by Target's strong free cash flow generation. Plus, the document points to management's commitment to shareholder returns. They note there's still $8.4 billion remaining in their share repurchase authorization.
Okay, so stock price way down, PE looks cheap compared to its history, dividend yield is historically high. What does the rest of Wall Street think, according to this analysis?
Well, the thesis notes that even with the price decline, the Wall Street analyst consensus is still a buy rating, their average price target, $131, which, from $93, that represents a pretty hefty 41% upside potential. And you got to look at the range. It's wide, $82 on the low end, $190 on the high end. So that definitely reflects some uncertainty out there. But the general agreement captured here is that, yeah, it looks undervalued. The thesis also looks at peers using metrics like EBITDA. It suggests Target's 6.8x looks attractive compared to a lot of competitors. And importantly, the argument is that Target still has superior operating margins and, frankly, a stronger brand than many pure discount retailers.
So for you, looking at this initial snapshot from the thesis, why frame Target as contrarian value? What's the foundation telling us here?
This section really just sets the whole thing up, right? The contrarian part is because the stock's been beat down so severely, most investors probably aren't rushing towards it. And the value comes straight from those metrics, the low multiples compared to history and peers, plus that high dividend yield. The thesis is basically saying, look, the market might have gone too far here, overcorrecting for the challenges Target's been facing.
Right. And what are those challenges? The thesis mentions operational challenges as a key reason the stock might be oversold. How does this document say Target is trying to fix things?
Okay, so this is where it shifts to what management's actually doing. The thesis highlights the announcement of this Enterprise Acceleration Office, and it calls this a significant strategic inflection point.
Enterprise Acceleration Office. Okay.
Yeah, it's not positioned as some quick fix. It's described as a multi-year thing. It's being led by the COO, Michael Fidelk, and the core focus is basically making Target faster operationally, simplifying complicated cross-company stuff, and using technology better. The author sees this as a really direct, proactive response to the execution problems that have, hurt the business.
Michael Fidelk, is he a new face? Someone brought in to shake things up?
No, not at all. Fidelk actually has really deep roots at Target, like 22 years of experience, and across key areas too: finance, merchandising, HR, operations. He was CFO since 2019 and Senior VP of Ops before that. So the thesis points to this deep understanding of the whole end-to-end business as a real strength for leading this kind of initiative.
Okay, so deep internal experience.
Right. And the thesis also mentions other leadership changes happening too. Strategic departures of the chief strategy officer, chief legal officer, and importantly, enhanced roles for other key leaders, like the CIO, the CFO Jim Lee, now focused on enterprise strategy, and the CCO Rick Gomez, focused on enterprise insights. It suggests a sort of broader renewal of leadership focus.
Hmm. It sounds like more than just tinkering around the edges then. Seems like a pretty significant effort.
Exactly. The source really stresses that this acceleration office is meant to be fundamentally different from just, cutting costs. It's about building long-term operational muscles, things like speed, adaptability, innovation, resilience across the whole company. The thesis argues this is a direct, credible answer to those investor concerns about how fast and effectively Target's been operating lately.
So as someone looking at this stock, why does this management initiative matter so much in this analysis?
It matters because the thesis frames it as management directly hitting back at the operational issues blamed for the stock's fall. If this office succeeds, it's seen as the primary catalyst that could drive a recovery and basically prove this whole contrarian value idea right.
Okay, so even with these operational stumbles, the thesis argues Target still has these fundamental strengths, these economic moats. What does the analysis say they are?
Right. These are the core things that, according to the author, make Target unique and hard to copy. The thesis lists a few key ones. First, omnichannel excellence. The analysis points to recent stuff like Q1 2025 digital comparable sales growth of 4.7%. That actually outpaced the overall company. Right. They also highlight same-day delivery growth over 35%, especially through Target Circle 360. That's their loyalty program, helps drive repeat visits and gives them tons of data.
Right.
And crucially, the thesis notes that 97.6% of sales are fulfilled by stores.
Almost all of it.
Yeah. And the author highlights this because it means that huge physical footprint isn't just for people walking in. It's a massive operational asset for digital orders. It lets them do faster, cheaper deliveries or pickups compared to just shipping everything from giant warehouses far away.
So the physical stores are actually key to their online success strategy.
Precisely. The thesis sees that tight integration, physical and digital, as a major competitive edge. It's convenient for you, the customer, and cheaper for Target.
Okay, what else?
Next, they talk about brand differentiation and design leadership. The argument is Target sits in this unique spot, right, between the discounters and the premium guys. This lets them attract a broader, often maybe more aspirational shopper. They point to successful designer collaborations, calling the recent Kate Spade one the strongest in a decade as proof of this appeal.
I remember that one.
Yeah. And private labels are mentioned too, obviously huge for margins. And that Target Circle loyalty program, again, driving engagement and giving them insights. Then there's the store network and real estate. Nearly 2,000 stores, strategically located. This physical presence gives them cost and speed advantages for digital orders, like we said. The author suggests this prime real estate is also a barrier to entry for competitors, and Target uses flexible store formats so they can adapt to different neighborhoods. And finally, scale and supply chain. $107 billion in annual revenue. That gives Target massive purchasing power, lets them negotiate better terms. The thesis calls their supply chain sophisticated and notes they're still investing in tech and automation to make it even better.
So the analysis seems to argue that even though operations got bumpy, the core engine is still very strong. For the listener, why should these moats matter now?
Well, according to this thesis, these advantages hasn't gone away. They're still there, still intact. They provide the underlying foundation for Target's competitive position. The author's view is, basically, once they get the operational execution fixed, these moats are what will power the recovery and long-term success. They're the inherent strengths that could help Target bounce back.
Okay, moving beyond just the dividend, how does the thesis describe Target's overall financial picture? How healthy are they?
The thesis says the financial foundation is still solid, despite the operational issues. They highlight return on invested capital, ROIC. It's 15.1% on a trailing 12-month basis. And the author notes, importantly, that 15.1% is above Target's estimated cost of capital. That means they're actually generating profit effectively with the money they invest, a key sign of a healthy business. The debt-to-equity ratio is stated as 1.36. The thesis calls that manageable leverage. Suggests they have financial flexibility, they're not drowning in debt. And they repeat that point about strong free cash flow generation, the cash left over after everything. That's crucial because it funds both the dividends and the investments they need to make. Document also notes adequate liquidity, enough cash for short-term needs.
You mentioned their commitment to shareholders earlier, especially the dividend. What more does the financial section say about that?
Yeah, it dives into the specifics on that shareholder-friendly capital allocation. The thesis makes a big point about Target's really impressive record, 54 straight years of dividend increases.
54 years, that's consistency.
Really is. They call it strong proof of their commitment to returning cash. They bring up that $8.4 billion left in the share buyback authorization again. And here's a really interesting detail they include. Target actually bought back $251 million worth of its own stock in Q1 2025. The average price they paid, $114.60.
Wait, hang on. They were buying stock at over $114, according to this thesis, just recently. When the price is now sitting around $93, that's noticeable.
It is, isn't it? That specific detail suggests management themselves saw value in the stock, even at a price quite a bit higher than where it is now. The analysis also notes the recent dividend hike in Q1 2025, up 1.8%, bringing the quarterly payout to $1.12 per share.
Okay.
And alongside these returns, the thesis confirms Target is still investing heavily. Digital, omnichannel, store remodels, supply chain, technology. They're putting money back into the business too.
So how does this picture of, solid financials support the investment case the thesis is building?
The author argues this combination, strong cash generation, disciplined decisions on where that cash goes, returns and investments, plus that long dividend history provides really crucial downside protection. That free cash flow especially is seen as funding those strategic initiatives needed for growth, while also keeping shareholders happy with dividends and buybacks. It sort of covers both bases.
All right, we've looked at the current situation, the management plan, the strengths, the financials, all through the lens of this thesis. So what does the author see as the potential future? What's the upside case, the bull case?
Okay, the bull case outlined here really centers on, well, operational improvement actually happening. Then recovering lost market share, and finally getting a higher valuation multiple from the market as a result. The key triggers or catalysts they identify are that enterprise acceleration office starting to show real gains in the next, say, 12 to 18 months. Improved execution helping Target win back some of that market share. The thesis noted they lost ground in 20 out of 35 tracked categories.
Wow, 20 of 35.
Yeah. They also expect tech investments to improve inventory and customer insights and cost optimization efforts to help margins. In this optimistic view, the thesis sees market share coming back in key areas like beauty, apparel, home goods. They expect successful seasonal strategies, more growth in Target Circle 360 memberships. Digital growth should accelerate as past investments pay off, and that store-based fulfillment keeps providing cost advantages. And crucially, the thesis projects that as execution improves, the market will likely re-rate Target's valuation. They see the PE multiple potentially going from that current 11x, maybe up to 14, 15x earnings. Just based on that multiple expansion alone, assuming earnings hold steady, the thesis suggests a potential fair value around $120, $130.
And what specific price targets does the thesis assign to these different scenarios?
Right. They give probability-weighted scenarios. Their base case, they give that a 60% probability sees revenue stabilizing by Q3 2025, margins improving, leading to a stock price target of $115 to $125. Then there's the bull case, 25% probability, which assumes a faster, better recovery, beating expectations. That pushes the price target higher, potentially reaching $130 to $145.
Of course, there's always the other side. What about the potential downsides? What's the bear case presented here?
Yeah, the thesis is careful to lay out the risks. Operationally, the risks are maybe the acceleration office just doesn't deliver the goods, maybe there's disruption from leadership changes, maybe market share keeps eroding, or they hit snags implementing new tech.
Standard execution risks, basically.
Pretty much. Then there are market and economic risks.
Yeah.
Things like consumer spending staying weak, especially in those discretionary areas where Target makes better money, more competition, tariffs or trade issues popping up, or just trouble managing inventory if the economy stays uncertain.
Okay, so what does the actual bear case scenario look like, according to them?
The bear case in the thesis assumes these problems prove, harder to fix or even get worse. So execution fails, maybe the shift away from Target is a more permanent thing, not just a blip. Margins keep deteriorating. Maybe leadership becomes unstable if things don't turn around. The bear case price target they give is $75, $85. That would be another, 15, 20% downside from the current level? Yeah. But the thesis also notes several mitigating factors that it believes limit how bad the downside could get. Things like the strong balance sheet we talked about.
Yeah.
The value of all that real estate Target owns, the author sees that creating a sort of asset value floor. Also, established brand loyalty. management's past experience navigating tough times, and again, that attractive dividend yield providing income even if the stock price struggles.
So, based on this analysis, what are the key things you should be watching if you're interested in this thesis? What should you monitor?
You definitely need to keep a close eye on the progress of that Enterprise Acceleration Office. Is it actually delivering tangible results? You'd watch market share trends. Are they stabilizing or improving, especially in those key categories? Keep tabs on the competition, obviously. And really importantly, broader consumer spending patterns. How are people feeling about buying clothes, home goods, that kind of discretionary stuff?
Okay, so bringing it all together now. Based on this whole analysis and the thesis, the valuation, the strategy, the strengths, the financials, the potential upside and downside, what's the final verdict? What's the investment recommendation here?
The final investment verdict in this specific thesis is a moderate buy.
Moderate buy.
Okay. And the author quickly recaps the core reasons why. That attractive current valuation, the 11x forward PE, the 4.6% dividend yield. They see management's proactive response to the Acceleration Office as a critical positive. The strong competitive moats, omnichannel, brand, real estate, they see those as enduring assets. And the solid financial foundation providing stability and funding the turnaround. The potential for significant value creation if operations improve is really central to their view.
And the price target?
The recommended target price given is $125 to $140.
Yeah.
And the time frame is over the next 12 to 18 months. That represents 35% to 50% upside potential, driven mainly by getting operations better and getting a modest multiple expansion back towards that historical 14-15x earnings range.
Okay.
They call the potential risk-adjusted return attractive. They see downside risk as relatively limited because of those mitigating factors, the assets, the dividend, while the upside potential, even in their base case, is over 40%.
And what about strategy? How do they suggest approaching it?
The thesis suggests maybe initiating a position around the current 93.3 level, potentially adding more if the stock were to dip below $85. The holding period they suggest is that 12 to 18 months. The first key check-in point would likely be the Q2 2025 earnings report, probably around August. And they suggest considering taking profits as the stock gets closer to that $125, $130 range.
So the core conclusion of this specific thesis boils down to target's current valuation when you weigh it against the challenges, but combine it with management's plan and the company's underlying strengths, looks like a compelling opportunity over the next year to year and a half. Is that fair?
That's a great summary, yeah. This thesis provides a really detailed framework. It gives specific reasons why the author believes in a potential recovery for Target, highlighting the factors they think are key, and offering potential price targets based on their analysis as of May 22, 2025.
All right, that brings us to the end of our deep dive into this particular investment thesis on Target Corporation. We've explored why it's being called a contrarian value play. We've dissected the operational challenges and how management's trying to respond. We examined Target's enduring competitive strengths, its financial picture, and looked at the potential upside and downside scenarios laid out in the analysis.
Yeah, and we've seen how the thesis really tries to connect the dots, right, between the current state potentially undervalued based on PE dividend yield and the catalyst for a potential recovery, especially the success of that new Enterprise Acceleration Office and the resilience of Target's whole omnichannel model and brand.
It paints a really fascinating picture, doesn't it? A company we all know going through a tough patch with a specific argument here for why the market might be getting it wrong, underestimating its ability to navigate through it. But here's where it gets really interesting, I think. As we've seen, this entire thesis pretty much hinges on management successfully pulling off this big, complex, operational overhaul and doing it within a relatively tight 12 to 18-month window, all while facing, potential economic headwinds and ongoing competition.
Which raises a really important question for you, the listener, to think about. How much weight do you put on management's ability to execute such a significant change that quickly versus, say, the potential impact of maybe more persistent shifts in how consumers behave or changes in the competitive landscape that might be harder to overcome no matter how well they execute? Is the real potential value here truly in that successful turnaround story? Or perhaps is the consistency and growth potential of that strong dividend backed up by solid financials and valuable assets the more reliable part of this whole equation for you?
Definitely something to mull over as you process the insights from this deep dive. Thanks for exploring this with us today on Stock Talk.